Today, we are discussing the federal budget 2026 to 27 and the rollout and what I'm hearing on the grounds after the last couple of weeks. So I thought it'd be probably easier to just run through a mail out that was actually sent to myself from my accountant of the key changes. And if you want any more help, guidance in this space, hit us up. We can connect you with our accountant, property tax accountant based in North Sydney, to get the more ins and outs of the impact to your personal situation. But we'll start with personal taxation, income tax cuts. The tax rate for incomes between 18,000 and 45,000 will be reduced from 16% to 15% as of the 1st of July 26, and a further cut to 14% as of the 1st of July 2027. So basically reducing the amount of tax on low incomes. So good for people on low incomes. Taxpayer savings, these changes will be reduced tax payable across the board by up to $268 from 26 to 27, and up to $536 between 27 and 28. So a bit of a handout, really much of a muchness. More so, I would say that's a political handout. If you're taking $100 away from one person and dispersing $10 to 10 other people, you make one person pissed off, but you make another 10 people happy. So I see that as just a political play. It's not going to really make any difference to the economy in any way or help people at the end of the day. Working Australia's tax offset. A new $250 tax offset is proposed from 1st of July 27, increasing the effective tax-free threshold for income from work to almost 20,000. Standard work-related deductions. A new $1,000 standard deduction for work-related expenses between 26 to 27 income year, simply claiming for employees. So I guess rather than needing a business to write off some cost expenses, this is more aimed at those who are an employee. Medicare levy, low income thresholds will be increased for 25 to 26 income year. Private health insurance rebate rates for people aged 65 and over will be reduced to align with under 65 rate from 1st of April 27. So essentially, in summary, for personal taxation, the government is looking to support low incomes, but those in the middle range, medium to high incomes, really no change for those. Business taxation, instant asset write-off. The 20,000 instant asset write-off will be permanently extended for small businesses with turnover under 10 million. So this is tools or equipment or vehicles. Every year you can write off 20 grand. Loss carried back. Companies with turnover under 1 billion will be able to carry back tax losses from 1st of July 26 and offset them against tax paid in the prior year. Startup support from the 1st of July 28. Eligible startup companies will be able to access refundable tax offset for those incurred in the first 2 years, that's a pretty good one. So if you're looking to do a startup and don't make much money in the first couple of years, you can offset it and bring it forward by the sounds of that one. Pay-as-you-go installments from 1st of July 27, eligible small and medium businesses will be able to opt into monthly pay-as-you-go installments based on real-time business activity. Well, that's just more of a cash flow item, not really much change there. Electrical vehicles. Who wants to buy electrical vehicle anyway? Changes to the FBT concession for electric vehicles will be phased in, moving to 25% discount from the 1st of April 29. All right, then miscellaneous items. These are the actual meaty part of the budget, the major CGT, trust, and negative gearing reforms. So capital gains tax from the 1st of July 27, the 50% CGT discount will be reduced with indexation and a minimum tax rate of 30% on realized capital gains. So if you buy a property after holding it for a few years, and then if you look to sell it, the current model is if you bought a property for 500 and sold it for 1 million, you would only be taxed on 50% of the gain. So the 250 grand would be taken, added to your personal income, and you'd be taxed at your marginal rate. Now they are scrapping that 50% discount and taxing on the full amount, subtracting out what was the inflation rate across the years of holding that asset. So if inflation kicks up and runs hard over the next few years, you could be arguably better off. But if we have low inflation, then you'd be worse off. So case by case, depending how long you've been holding the asset for, which will also be a minimum of 30%. So what I see happening is people less inclined to sell. Just hold on, refinance. It'll create a gridlock with properties in the market, less supply coming on, being transactions, means there'll be less properties on the market to purchase. Ever-growing demand for people to buy. If there's ever-growing demand and less supply, prices will keep on keeping on. So I see it restricting listings in time as you basically disincentivized to now sell. And people are now, I guess, thinking around ways of how to get around it. The only way to get around not paying it is don't sell and just refinance, hold onto the asset and hold it through longer stagnant periods, which is probably only a reason why to sell an asset. If you've held it through a growth cycle, it's only going to go through a stagnant period. You could sell to realize those gains, pay the tax, free up serviceability, pay down debt, reinvest the capital gain into larger assets like blocks of units or commercial. Just like playing Monopoly, 4 greenhouses, 1 hotel. If you are selling an individual property to buy a larger deal, a block of units in a market that's going to set to run through a growth cycle, then it can make sense. However, you need to run your numbers now and work out whether or not it is worthwhile selling the asset because it might trigger a big tax bill. Discretionary trusts from the 1st of July 28, a minimum 30% tax will apply to discretionary trust income with non-refundable credits flowing to beneficiaries. So basically slapping 30% across all trust structures. So again, this is, I guess, going to change the way people think about how to structure properties, if it's whether or not it should go into a trust structure or maybe a company or even your self-made super fund or personal name. Personally, I have them everywhere. I've got properties in personal name, trust structures, self-made super fund. I'm currently in the process of setting up a holding company to tack on the side of my trading company so I can get income out of the trading company, pay 25% tax, put all the income into holding companies to buy real estate. Rather than drawing the money out of the business, paying 47% tax to the ATO, you can work out different ways to minimize that. Get a good accountant. I had to get rid of my old accountant. He didn't know what I was trying to do. So at some stage you outgrow the people that help you. And I always say if you're not getting answers, if the answer is no, that means it's time to find someone that can say yes, and so you can keep moving forward. But yeah, discretionary trust structures, now you're getting 30% tax across the board. So I guess you can't now disperse incomes to, I guess, say beneficiaries or companies to try and minimize tax. It's 30% slapped across those structures as a minimum. Trust restructuring. So this is an interesting one. Temporary rollover relief will be available to support restructuring out of discretionary trusts. So between now and probably the 1st of July 28, it gives you the opportunity to look at restructuring out of trusts if you're looking to move them elsewhere to put them in a more tax effective environment. Negative gearing. From the 1st of July 27, negative gearing deductions will be limited to newly constructed residential properties with existing investments grandfathered. So moving forward, you will only be able to negative gear against new builds and those that have bought existing as being grandfathered. But moving forward, I see impacts to the market. There's a couple of impacts I've recently noticed is, I mean, first of all, people just jacking up rents. People are panicking, worried about what's going to happen, and rents are rising quite aggressively. So rents are going to keep going up. I mean, they've put models out there saying that rents will only rise by $2 a week or something a year. Fucking bullshit. I can tell you right now, rents are going up hard, 50, $100. Well, what I'm seeing, especially at the lower end, because there's just not enough stock. And now they're disincentivizing, the average investor that looks to go and buy something to negative gear. It was incentive to get more people to buy investment properties to create more rentals in the market for renters. Now people are thinking, okay, well, if you can't do that, what do we do? The water will find its level. So there'll be less people looking to now buy rentals, investment properties to negative gear, so they'll put their money elsewhere. That money may chase new builds, which, I mean, it's not a very good idea to go and buy new and off the plan, especially peak market coming into the final euphoria state where, anything being sold new and off the plan these days are being sold out of predominantly Queensland, WA, South Australia, where those markets have been pumping. There's not much new and off the plan being sold in the likes of Sydney, Melbourne. Just the price points are just too low relative to the build costs, and nothing stacks up from a feasibility perspective. So people will chase the new off the plan peak market, overpay because of incentives for negative gearing, and end up learning the hard way. I'm also seeing that people's incomes or borrowing power are being restricted now because the banks factored in a cashback for negative gearing come into financial year for people's serviceability. So a couple of clients they've been working with, they've had their borrowing power shrink by 10, 15%. So we've had to fine tune their scope, specific scope, because their budget has shrunk with this rollout. So that's another impact they'll continue to evolve over time, is banks will start pricing in this to people's serviceability. So then people's serviceability will shrink. Therefore, people won't be able to borrow more or buy as high price points. So a lot more people are getting forced into the lower and lower brackets, the entry level stock, because of increasing interest rates and now taking out negative gearing. It's reducing people's borrowing power. So the bottom end's getting super competitive for established stock, and especially now more high yielding. So we've always stuck to high yields between 6 to 8%, but now it solidifies to the skeptics of why we do it. It's not blue chip, it's overvalued. If you're buying property with a yield less than 5%, it is overvalued. It's not blue chip. We were buying houses in Brisbane for 250 grand 7, 8 years ago. Now people are calling them blue chip and buying them for $1 million plus. It's not blue chip. It's overvalued. Now, the yields at the time were 7.5%. Now yields are 3, 4%. So low yields are a leading indicator for a long, stagnant, flat market because it takes time for the local wage to rise, for people to borrow more, to pay for more for rents, which sets up the fundamentals for the next growth cycle. Because you'll find rents rise first, creates attractive yields, brings all the smart investors in first, then it becomes well mainstream that this is the next hot market and every man and his dog starts plowing in and that sets off into a boom. And then all the punters rush in tail end thinking the party goes on forever until the lights come on, the party's over, and the market goes through hard downturns for many years. It's human psychology, it's investing. We've gone through this before and we're seeing it roll out before our eyes again. And now, yes, negative gearing will disincentivize some investors, but for those that are structuring in trust structures, self-managed super funds or companies, you couldn't negative gear anyway before all this. You could only negative gear if it was in your personal name. So most of the stuff we buy is going into trust structures, companies, and self-managed super funds. So cash flow is king. You want your portfolio cash flowing. You want to build it, run it, structure it just like a business so that banks can keep lending you more money, so you can borrow more, so you can buy more property, and then keep on keeping on, keep powering on. Superannuation, interesting. I mean, no major changes were announced for super in the budget. Existing reforms continue. So payday, super, and Division 296 tax on super balances over 3 mil remain scheduled to commence on the 1st of July. So they're basically increasing taxes if you've got a balance more than 3 mil, and sub 3 mil pretty much stays the same. So it's a good way, super's a good way to build your portfolio out because you can be maxed out in your personal name, you can be maxed out in trust structures. But if you got the capital sitting in your super, 20% for metros, 30% for regions, generally, the second, third tier lenders will lend you the money, provided you've got a job. They don't look at serviceability, etc. They just want a good spread and they'll lend you the difference. So you can be maxed out personal name trust structures, but you can keep going further in your super, provided you can raise the capital for the deposit and closing costs. So you can use your contributions from your work over time, they'll build up, but then you can beef it up by way of drawing equity out of properties in your personal name or trust structures to transfer the equity into your super. You can forward contribute, you can back contribute, you can also lend money into your super. So there's many ways to get more money into your super to beef it up. And that's all you need to do. Beef it up, and then the banks will lend you the 70 to 80% more, depending where the property is located and the yield. You need at least 6% yield typically. They will lend sub 6%. So hits our realm of what we're buying now. We're buying individual unit villa townhouses in metros with 6 to 8%. Houses in the regions and metros just don't stack at this stage of the cycle. So we're not buying a heap of them. We do buy occasional, but not as much at this stage because yields are between 4 to 5.5, maybe 6 just, but um, not high enough to put into a super fund at this stage. Eventually they will come good, but everything has its time in the sun. And then we're also finding great value in blocks of apartments, both in metro and region. I do also like predominantly blocks in the regions personally because of capacity reasons, but then also high yields, high yields in the regions typically, and low land value. So then you don't get slugged with land tax. So you might find deals in metros where you get a good yield but by the time you factor in land tax, fucking kills it. So good way of avoiding that is buying individual 1 and 2 bed unit villa townhouses in metros, spread it out across multiple markets and sites, and then buy the whole blocks in the regions. And keep on powering on. CGT Super complying superannuation funds are exempt to continue receiving a CGT discount of 33.25%. There you go. So super didn't seem to be touched in the budget, that is. I mean, they were fiddling around with it before. It's mainly been, I mean, the key items were obviously the negative gearing being scrapped for existing trust structures are now getting taxed minimum 30%, as well as capital gains tax is now minimum 30%, where before it worked out to be minimum 25%. So raising taxes on people that hold assets and then dispersing it to people on low incomes, getting reduced taxes, classic Labor government. So see how it all pans out over the coming years. Don't be surprised to see higher rents, which will ultimately get capitalized into higher prices, and the wealthy will continue to get more wealthy, and the poor will continue to get more poor. So best to take action, keep powering on. Don't worry about all this headline noise. If the banks will give you money, take it, put it in the market, provides the right market, the right price point, the right yield, the markets will keep moving on. And politics changes, it's cyclical. It's not a reason to sit on the sideline. I hope that helps. As a summary, if you want help, get in touch today. We can connect you with our property tax accountants to give you an even further detailed, personalized breakdown from the budget and a personal strategy for you moving forward to keep building out your long-term sustainable portfolio and your wealth. Till next time, thanks for watching.